If you're coming into commercial real estate from the residential sector or from a different industry altogether, the financing of commercial properties and the terms associated with commercial real estate loans can feel pretty complex. The way these loans are structured, how payments are made on commercial real estate debt, and even the fees and penalties to look out for when financing these deals are all pretty unique, but these are also really important things to consider when you're trying to value commercial properties and dial in your underwriting. So to make sure you understand some of the most important pieces of commercial real estate debt, especially in the midst of all the uncertainty we're seeing in the market right now, in this video we'll cover 4 things that you need to know about commercial real estate loans before getting into the game and how each of these things can impact a commercial real estate deal. So the first thing I want to highlight here is directly related to interest rates and how these are determined by commercial real estate lenders. And this is that on commercial property loans, interest rates are made up of 2 different components, an index rate and a spread. And the index rate is generally going to be the equivalent term risk-free rate in the market that represents bond yields with the same maturity date as the loan and an assumed 0% default risk by commercial real estate lenders. For fixed rate loans or loans with an interest rate that doesn't change throughout the loan term, the index that's generally going to be used is the equivalent term US Treasury yield, meaning that for a loan with a 5-year term, the index on that loan would be the 5-year US Treasury rate at the time the rate was locked. But the index rate is only one piece of the equation when calculating the all-in interest that a lender is going to charge, and the spread on the loan also needs to be factored in. And this spread is going to be based on the assumed level of risk the lender is taking on and the volatility levels in the markets. So when interest rate movements and the risks associated with a given deal are low, commercial real estate loan spreads will also usually be low. And when interest rate environments are more volatile and the risks associated with a given deal are high, commercial real estate loan spreads will also usually be elevated. Now, interest payments aren't the only cost to borrowers on commercial real estate loans, and penalties and fees can also be substantial. And point number 2 on this list is related to this directly, and this is that when commercial real estate loans are paid off early, there can be substantial penalties that are associated with this. Unlike mortgages on owner-occupied single-family homes that can typically be paid off early without any sort of prepayment fees, if a commercial real estate loan is paid off before the end of the loan term, whether an investor wants to refinance a deal or sell a property outright, it's usually not going to be cheap to make that happen. This is especially true in situations where interest rates have dropped since the initial loan proceeds were funded, since commercial real estate lenders need to maintain their yields, and if a borrower pays off a loan early, now that lender needs to go back out into the market with additional capital to deploy just to earn that same return. Prepayment penalty calculations can sometimes be as simple as a percentage of the outstanding loan balance at the time the loan is paid off, but these can also sometimes be more nuanced formulas in the case of yield maintenance, which calculates the present value of the remaining loan payments that the lender would have received if the loan wasn't prepaid, or in the case of defeasance, which essentially requires a borrower to replace the lender's yield with government-backed bonds that can replicate the cash flows of the remaining monthly payments. It's also important to note that commercial real estate loans might include what's referred to as a lockout period, or a portion of the loan term in which the loan actually can't be prepaid at all, meaning that even if a borrower was willing to pay a penalty to refinance a loan at a better interest rate or to sell a property with an offer on the table they just couldn't refuse, they may not be able to make those things happen, even if they are in the best interest of the investor. Now, the next thing that often trips people up about commercial real estate loans, especially those that are coming from the residential sector, is that the amortization period of a commercial real estate loan is often significantly different than the loan term. On residential single-family home loans, you'll usually see 30-year loan terms with loan payments that are also calculated based on a 30-year payback schedule, with a goal to have that loan paid off in full by the borrower at the end of that term through fixed monthly payments. But on commercial real estate loans, to mitigate their risk, lenders usually won't offer loan terms of more than about 10 years in length, with 3, 5, and 7-year terms also being common. And with that condensed loan term time frame, in order to keep debt service payments manageable for investors, commercial real estate loans will still often include a 25 or 30-year amortization period that's used to calculate monthly payments on the loan, regardless of the length of the actual loan term itself. This creates what's referred to as a balloon payment requirement, when that entire outstanding loan balance needs to be paid off in full at the end of the loan term. And this is part of the reason why there's so much concern right now about commercial real estate loan maturities, since in many markets and product types across the country, property values have actually decreased over the last few years, and with interest rates significantly higher than they were in 2019, 2020, and 2021, this could create a lot of issues for borrowers that don't have access to new loan proceeds that can fully cover a required payoff. Many commercial real estate loans also include an interest-only component where the outstanding principal balance isn't being paid down at all on a monthly basis, and when values have dropped by 15 to 20% or more in some markets, and interest rates have increased by 250 to 400 basis points on some loan products, this is going to create a significant gap in financing, requiring equity investors to infuse additional capital into deals just to prevent having to sell at distressed property pricing. And directly related to this process of refinancing and the amount of loan proceeds that a lender is going to provide, the last point I want to make in this video is that unlike most single-family home loans, commercial real estate loan funding is generally going to be based not only on the property's value, but also the income the property can generate. Right now, commercial real estate lenders are looking very closely at a property's debt service coverage ratio, or DSCR for short, which measures the amount of times over a property's net operating income, or operating revenue minus operating expenses, can cover annual debt service that would be owed on a loan. And usually, lenders are going to want to see this DSCR figure fall somewhere between about 1.25x and 1.4x, depending on the product type and the risk associated with the deal. But if the NOI of a property decreases or debt service payments increase due to interest rate increases, the amount of loan proceeds that a lender is going to be willing to issue today is going to be substantially lower than what that amount would have been with those same DSCR requirements just 2 to 3 years ago. Even for product types like multifamily and industrial that have seen massive increases in net operating incomes over the last few years, the massive run-up in interest rates we've also seen during this time may still end up causing issues when these deals need to be refinanced. And to run through an example of what this might look like, if an investor took out an acquisition loan of $10 million financed at 3% interest back in 2020, assuming an amortization period of 30 years, the annual debt service on the loan would be $505,925. But if that original acquisition loan was now set to mature this year in 2023 and had to be refinanced in today's interest rate environment, if we assume a 6% interest rate on the new loan proceeds, keeping all other variables constant, a $10 million loan would now require annual debt service payments of $719,461. And what this means is that if debt service coverage ratio requirements stayed the same on this deal, this would now require the property to have seen a net operating income increase of over 42% during this 3-year period just to get back to that same $10 million loan value, and this isn't even factoring in any sort of loan origination fees that would likely be associated with a refinance. Now, obviously, every commercial real estate loan product is going to be a little bit different, but with current market conditions as they stand today, these are 4 things that are definitely worth paying attention to and some of the most important components of commercial real estate loans that are going to have huge implications for investors over the next 12 to 24 months. And if you want to learn more about commercial real estate financing and how to model commercial real estate loans when analyzing potential investment opportunities, as always, make sure to check out our all-in-one membership training platform, Breaking a CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Breaking a CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on this channel on commercial real estate loans and the debt side of the industry in general, make sure to hit the like button and let me know in the comments any other debt-related topics that you'd like to see covered in a future video on the channel. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.